Thank you for joining today's webinar on the impact of COVID-19 crisis on global real estate. My name is Hank Kim, and I'm the Executive Director of NCPERS. Today's program is part of our expanded Center for Online Learning. As we all adjust to the new COVID reality, please bear with us if there should be any technical issues or background noise during our webcast. As always, your patience and understanding is appreciated. We encourage audience participation. Please submit questions by using the GoToWebinar portal. However, to ensure that we can cover all our topics, we will hold your questions till the last part of the program. Additionally, in the handout section of the portal, you will find a PDF of today's presentation. Today's webcast is sponsored by Nuveen. To introduce the firm and our presenters today, we have with us Kitty Martin, who is responsible for Nuveen's U.S. institutional sales and client services effort within the public funds channel. Kitty, thanks for joining us today, and the webcast is yours.
Thank you. Good afternoon. I'm Kitty Martin with Nuveen. Before we begin our prepared topic, I want to say thank you to all of the many people who are working hard every day to keep us safe and healthy. Thank you for what you do. Thank you for taking care of us. And thank you for letting us help you and your loved ones retire gracefully after your years of service. With me today from Nuveen Real Estate are my two colleagues, Wendy Price and Melissa Reagan. We're pleased to be part of the NCPERS series, and today Hank has asked us to speak on the impact of the COVID-19 crisis on global real estate. Hank, thank you for this opportunity. Before I turn the session over to Wendy and Melissa, I wanted to take this opportunity to provide a brief overview of Nuveen. Nuveen is a global and diversified firm. We're the 15th largest asset manager with $1 trillion in assets under management, which means we have the scale and the resources to meet our clients' needs. And we're on slide 3, Amanda, if you wouldn't mind flipping it for us. We have a great incentive to focus on delivering alpha because $283 billion of our assets are those of the general account, which means our goals and incentives are aligned with our clients. We're proud of the fact that we manage 5 of the 10 world's largest pension funds and that we have over 1,000 institutional clients in 40 different countries. As you can see from the asset under management breakout at the bottom of the page, we have experience across the entire capital structure from fixed income to alternatives. Next slide, please. We focus our expertise in 3 main areas: yield, alternatives, and responsible investing. Our history goes back over 100 years in fixed income and serving retirement and insurance clients. We have one of the largest fixed income research teams with 25 municipal analysts and 60 global fixed income analysts. With respect to alternatives, we offer a diverse platform. In addition to being a top 5 real estate manager, we are the largest farmland manager with over 2 million acres worldwide. We also manage $2 billion in timberland, $4 billion in energy and infrastructure, and we have a track record of over 30 years in the commodity space. In addition, we have $20 billion in private credit and over 40 years of private market experience. In terms of responsible investing, we're one of the earliest firms to have engaged in responsible investing, starting in the early 1970s. We have over 100% of our assets committed to UNPRI, and we have over $27 billion in ESG-focused strategies. We're also one of the only firms that has a private equity impact fund, focusing on inclusive growth and resource efficiencies. Next slide, please. As I mentioned a moment ago, Nuveen is a global diversified firm. And so is our real estate platform, where we have a global presence with local expertise. We're one of the top 5 real estate managers with $127 billion of assets under management. We have over 630 people in 25 different locations throughout the US, Europe, and Asia Pacific. This means we have boots on the ground in the areas that we invest in. Next slide, please. We work closely with our clients to develop long-term strategic relationships, to understand their goals, and to meet their requirements. In response to those client objectives, we have developed a range of real estate solutions: the Resilient Series, the Enhanced Series, and the Debt Series. We've tailored our solutions to offer investment themes, strategies, and vehicle types to meet our current and our future investors' requirements. I now want to turn the discussion over to Wendy and Melissa. Melissa Reagan is the head of research in Americas. She leads a team of research and strategy professionals focused on the U.S. direct real estate market. She collaborates closely with Nuveen Real Estate's global head of research, and her deep expertise contributes to all of our investment decisions. Wendy Price is a real estate product specialist who's responsible for supporting the distribution of the Nuveen Real Estate capabilities. Wendy and Melissa will now share Nuveen Real Estate's thoughts on the impact of the COVID-19 crisis in the global real estate market. Wendy?
Thanks, Kitty. And I echo your sentiments about, the teams of wonderful people who are out there on the front lines, and appreciate all the efforts. So, we've had an interesting roller coaster couple of months, as we all know. So why don't we just jump right in and, high level a bit first. Melissa, could you share some of your views on the economic outlook? And there's the debate, is this going to be a V-shaped or a U-shaped recovery? And interesting to know, as a researcher, why you form these opinions and what type of data you've been using to come to these conclusions.
Yeah, sure. Great. Maybe we can move to slide 9 to kick off this conversation. This is a global view, but from a U.S. Pure context, this is data from the IMF, and so they expect the U.S. economy to contract 5.9% this year, and then, as you can see, rebound to 4.7% in 2021. Now, this has caused a lot of questions around. That sure seems like a V-shaped recovery from the IMF. Now, I think in terms of the shape of the recovery, it's completely and totally uncertain whether it be V, U, squishy, squish, the nice squish. You hear all these terms. I think how we can think about it, and the way I think about it from a real estate perspective, is here's what I do know. I know that the decline in GDP this year is going to be almost more than twice as severe as that decline that we saw in 2009 during the global financial crisis. And the decline will be on record, it'll be the second largest decline outside of the Great Depression. In terms of the shape of the recovery, I think about it more in terms of the next couple months, and then kind of the next 6-9 months is how I'm thinking about it. So in the very near term, I think what will happen is you'll get businesses are going to start to reopen here after Memorial Day. And I think that the stock market's really, pricing that in and saying, okay, businesses are going to start to reopen. People are going to start going back to work. Cities are going to start to, people start, moving around a little bit more. And I think then you'll have the effects of the fiscal stimulus. That'll sort of all come through this summer. And I think you'll get kind of that short-term boost this summer, right, in terms of GDP. And I think that's what the financial markets are absolutely pricing in at this point. However, then I think about what happens in the fall. So by the fall, we'll start to see kind of the corporate defaults come through because of just the immense fallout we've had. You have to remember there's both demand and supply have seized up at this point. So there's a lot of companies who are going to struggle to produce the revenues they did pre-COVID. So you'll get the corporate defaults moving through in the fall. By that point, you'll also start to feel the real effects of the unemployment. And that report that came out last Friday was nothing but dramatic and unprecedented. Unemployment rate's probably going to go to 20% here, maybe even more by the time this is all said and done. So what I think is that by the time we get to the fall, we're going to start to see some of this, the actual real impacts of this recession hit. And I wouldn't be surprised if then we have sort of another kind of drop off in GDP and financial markets. Wouldn't be surprised at that at all. I also think what you could get is another round of the coronavirus that picks up again in the fall and again, and who knows how we handle that, if that's another shutdown or whatnot. But these are the way I don't really think about it in terms of what the shape is of the recovery, because I don't know. But that's sort of the framework that I'm thinking about right now for the next kind of 3-6 months, for this recovery.
Thank you. So, there's a lot of unknowns, but, are you seeing any common themes globally? Nuveen is the firm, we have a lot of data with $1 trillion of assets, and particularly in real estate with our, exposure in Europe and Asia and the US. So, what are the similarities and what are the dissimilarities that we're seeing from the different regions, both in an economic sense and then also, more on the property equation?
Sure. Well, I think from the economic sense, we can use this slide is perfect. I think it says it all. It's all economies are really going to see a fallout in 2020 with a rebound in 2021. But I think if we move to slide 14, maybe I can pull it into some of the real estate, specific real estate, what's going on globally. So this is really good. It doesn't include Asia, but most of Asia would be the same. And I actually think this slide kind of sets the table and provides context for most of the rest of the conversation around real estate. So what we're seeing globally that's very, very similar, the fallout in retail is certainly a common global theme that we're seeing across, whether that be malls or strip centers or grocery stores globally. That's certainly happening. We expect retailer defaults globally to really speed up. We think that, the coronavirus and how we think about investing, pre-coronavirus versus post, it's more just an acceleration of trends. So retail is one of them. I think we think the demise globally of retail just speeds straight up. What this chart is showing is rent collection across the different property types. And as you can see, rent collection, now this is really just for the month of April. We don't know May. We'll get May here pretty soon. Retail rent collection is just falling through the floor. As you can imagine, most retailers are saying, hey, I'm really struggling to just survive. I can't pay rent at this point. So that's a very, very common global theme. I think as we move to office, so rent collection so far has been pretty strong. I would say not as strong as industrial or apartments, but globally, I would say decently strong. And I would say we're seeing very similar themes globally, that the very highly capitalized blue chip corporations are certainly able to pay their rent. And the ones that are high yield or smaller businesses are struggling to pay their rent. And that's another global theme. And I would also say, co-working, which has, really sort of came into its own in the last decade globally. Now that is also struggling across all three regions as well. At the same time, to retail's demise has been industrial. That's the next, rent collections have been very strong there. We actually expect e-commerce retail sales. What we can learn from China is when they had SARS in 2003, that's really after, so people started shopping online during SARS, and it just really sped up, doubled e-commerce sales in China after SARS. We expect something probably not to the same magnitude, but something pretty similar actually globally. And so whether that be the US, Europe, or Asia, that e-commerce retail sales are really going to pick up. People will get used to shop. Those who didn't shop online before this crisis started shopping online and probably will continue to shop online. The interesting part about industrial and where those themes kind of are a little bit different is the reconfiguring of supply chains and out of China. And so what we have seen in the last sort of decade, and actually probably more than 2 decades, is, everyone went to China, had a lot of their supply chains there. Labor was cheaper. It's just cheaper to get goods manufactured there. And so what you're seeing now is more of a diversification of supply chain. So American and European manufacturers are going to be diversifying their supply chains. And that will actually affect those 3 regions very differently. So from a U.S. perspective, while we're not entirely sure how it'll affect the supply chain reconfiguration, we expect you could actually get fewer imports on the West Coast, which could affect West Coast import demand, but more imports on the East Coast and the Gulf Coast. And so you sort of see similar reconfigurations around the world from an industrial perspective. I'd say from a housing perspective, so the way it really differs globally is just sort of the types of housing that exist globally. So here in the U.S., when I talk about housing, I mean multifamily rentals, I mean single family homes, I mean manufactured housing. Not all of those property types exist in other countries. Multifamily apartments do exist in Asia and Europe. Manufactured homes to a much less extent, really only known in Australia. And single family rentals, the same thing, much less of an institutionalized, if even exists in those other countries. However, I would say globally, when we think about the rental market, we're very bullish on it. And we think that what this crisis will do, similar to what the global financial crisis did, is destroyed wealth among, sort of the younger people. And so that leaves them, with their best option is really to rent. And in the global financial crisis, quite frankly, when you look at it, homeownership rates have never come back in the U.S. to what they were. And wealth, almost destroyed a decade of wealth for millennials and Gen X. So those is another really global theme. I would say another global consistent theme that we're seeing is, the alternative property types. And so we are seeing really strong demand. Those are holding up really well across all of the regions. And by that, I mean things like data centers and cell towers, things like medical office and life science. So those are some of the global key similarities and key differences.
That's interesting. You talked a lot about rents, and in particular, Asia might be a foreshadow for what's to come, here and in Europe. So, and in Europe's even a few weeks ahead of us. So, just, based on the data we have, how much are rents really down and values in Asia now that they're starting to come out of the situation? And, do you think that can tell us anything about the recovery in the US and Europe?
Yeah, absolutely. So we don't have, the fortunate and unfortunate part of private real estate is that we don't always have, real-time data on rents and values. But what we do know from Asia so far is that transaction volumes in the first quarter of 2020 in Asia relative to Q1 2019 were down 56%. Now our analysis would suggest that, that transaction volumes tend to lead values. So you could think values are certainly going to fall in that same 50% in Asia, but certainly foreshadowing values to fall in Asia as well as Europe and the US. I think if we move to slide 15, what I see here, when I think about in terms of from the U.S. Perspective of NOI growth, I look at it from a GDP perspective. So this chart is really showing the correlation between NOI growth and GDP growth in the U.S. It would be similar around the world. So GDP fell 4.8% in Q1 of 2020. Expected to fall anywhere between 25 and 30% at an annualized rate in Q2. So you would expect NOI to fall, really in line with that because of the historical relationship. And then I think if you go to slide 16, it really highlights, some of the work we've done in thinking about just, how these property types have responded to different types of recessions. And this is a purely U.S. focused piece of work. But, values fell 32% peak to trough in the last global financial crisis that happened over a period of 2 years. And so, all I could say is that we do look to Asia to see what is happening. We don't know yet. So we kind of have to piecemeal it together between, what we know so far in Asia, what we know so far about, the U.S. economy contracting and then past recessions.
Interesting. Just looking at the data here. So, you touched on some of the strategies, right? That might have more resilience during the cycle, like in industrial and multifamily. And you also mentioned some of the alts real estate. But, from a U.S. perspective, I'm sure a lot of folks here joined because they're interested to know where the opportunities lies. So which property types do you really think are going to, perform well, or maybe even perform better or be more resilient throughout this cycle, and which ones less? And, obviously there are some, tailwinds in e-commerce, but, let's dig into a little bit more behind the reasoning between the property types.
Sure. So I think if we move to slide 19, that'll sort of set the stage nicely for this discussion. So unfortunately, when I created this presentation, I didn't actually have, Green Street actually released just last week their commercial property price index by property type. And that's really the first data point we actually have on where private market values are falling. When I created this presentation, all I really had was the public market data. And so mostly going to say the same thing, just so there's really no disconnect there. But so what we do is we look at how these property types are trading in the public market, in the public REIT market, their discount or premium to intrinsic asset value, to try to get a read on which property. It's imperfect, certainly imperfect, but we try to get a read on where we think values are going to go by property type, and then why. And so if we look at this, we are, pretty much in line, I would say, with a lot of where the consensus is on this. So I really think, let's start with retail. We talked about that a little bit. Retail is probably going to see some of the most significant property declines or value declines here in the next year or so. It's already starting to come through. I actually think Green Street had mall values down 20% in April of 2020. That's fairly dramatic. That would be even more than what you're seeing here. So retail is going to undergo a really significant shift. Now, that doesn't mean that there's no opportunity. I just think it means there are going to be much different opportunities. So what I really think it means is that you're going to get a lot of retailers that just didn't have very good business models, quite frankly. They're all going to sort of get, will file bankruptcy, go into liquidation. Some may keep stores open if they're not in liquidation. But for the most part, the retailers that just weren't very good are going to go away in the next year or two. And so that will accelerate that process. What that means for retail is that you'll probably have a lot less retail in the U.S., which is probably good because we were already over supplied on a per capita basis anyway. And then what you might get is just some more interesting experiential and experimental retail. And I say that because retail rents are going to fall pretty dramatically here. And what I think that'll do is hopefully spur some innovation in terms of restaurants and just do pop-up shops and new retailers. So I think there's opportunity there. I just think in the near term, there's huge amounts of value decline to be seen as we work through that. The next one is, student housing. So when we think about student housing, it's an interesting one. Probably going to see a pretty significant value decline along with retail and along with lodging. Student is one where, even pre-COVID, you had a really big demographic headwind. If you're aware or not, but starting in 2007, the fertility rate really started to drop off. The number of births per woman started to drop off in the U.S. pretty dramatically, not actually replacing ourselves. And so that's all going to start to feed through here in the next 10 years in terms of who starts to go to college. There's going to be fewer and fewer heads and bodies entering college from a U.S. domestic perspective. So you've got that headwind, and then student housing also got to be priced pre-COVID very near apartments, which doesn't really make too much sense because student housing actually carries a lot more operational risk than apartments. So you have a lot of headwinds with student. I don't think it'll be as bad as retail, but I do think there'll be a pretty big price decline in student housing. So that's kind of all the really negative side of the house. Where are we really positive? So like I said, let's dig into some of the alternative sectors. So I would say, the housing sectors among the alternative property types, things like manufactured housing, single family rentals, we're really positive on. Now, why? I sort of alluded to it. I do think you are going to get a generation of wealth destroyed. And I think that will certainly push people to have to force really to do more and more rentals. And whether that be apartments or single family rentals or manufactured homes. So I think you'll have that really good tailwind behind you from just a pure demand perspective. I don't see home ownership rates, moving up after this. I see them, home ownership likely moving down. I also think what'll really benefit something like a single family home rental is that you have millennials, which the oldest millennial right now is 39. And so they're starting to form families. And what that means is that after you start to form families, most apartments are just going to be too small because there's not many apartments. There's only like 20% of all apartment stock has 3 bedrooms in it. So once you start to have children, you want to move to a house. And if you can't afford to own, then you rent. And so single family, so you've got this whole wave of millennials coming through really in the next decade, as they push out. And COVID probably just amped that up, right? If you're sort of living in a city right now in an apartment and you're thinking about starting a family, you're probably like, well, it's probably just time to go, right? I don't want to be around all these people. So you've got that we're really positive on. Manufactured homes, we're really positive on that because, NOI growth has never fallen. It's the only property type where you can say this with a straight face. NOI growth, net operating income, has never fallen in any recession for manufactured homes. I don't know if that will change this time around. I don't want to make claims that I don't know, but so why was it so strong? So first of all, it really caters to those that make $40,000 or less a year, and that's about 45% of America. And so you've got a really strong demand base. Manufactured homes don't get built because of not in my backyard syndrome, so you don't really see a whole lot of supply. Huge amount of demand. And the other thing is that most people don't really understand about the sector is that actually most tenants actually own their manufactured home and it's ground leased. And so when you enter a recession, it's stickier, right? You want to go to the kind of end of the earth to at least maintain and keep your home. And so you may default, but it is a bit stickier of a base. Now, from the technology side, so the data centers and cell towers, those have been doing incredibly well. As you can imagine, everyone's at home now on Netflix watching TV. Work from home certainly has really amped up the amount that needs to get stored in the data center. So I don't see that going away at all. The demand behind those two sectors, it's a long-term secular demand trend. I don't actually know at this point what would throw that off. There has been quite a bit of supply in data centers from, there's a couple different types of data centers. There's been supply in what's called the hyperscale. But overall, if you think about companies also wanting just to outsource their IT, that's actually being amped up after COVID because they're saying it's actually cheaper for me to outsource it and I need to cut costs. And so when you have to do that, you outsource it and it goes into a data center. So you have a bunch of secular trends, behind you. Now, the other interesting part is industrial, which we talked a little bit about from the supply chain perspective. But if we bring it back just here to the U.S., what's really interesting about that is, so from a very long-term perspective, I absolutely believe that e-commerce will ramp up. There will be very strong demand for warehouses. In the near term, where I sort of disagree a little bit, from the consensus view, is that you have to remember you still do have tenants in warehouses who are high yield or smaller businesses, and they are going to struggle during this recession. And so in the near term, I do think you'll have a little bit more pain in warehouse than people tend to think. In the long term, I think it'll be spectacular. I do think you'll get the real boost from e-commerce. I'd also say, moving on to, we didn't hit on the other sectors we really like is healthcare. So if you think about kind of healthcare, technology, and housing, those are the sectors we are very positive on. Healthcare can mean a lot of different things. I tend to put life science and medical office in healthcare. Some people put senior housing in healthcare. From a life science and medical office perspective, life science is certainly the demand there. You've seen very high rent collection, like 98% of tenants have paid, life science tenants have paid their rents in April. Could change going forward, but that certainly outpaces traditional office. And a lot of those tenants are developing drugs. And so almost all the tenants in a life science building are either biotech or medical technology tenants. They are developing drugs, and that certainly is in very high demand in a COVID world. As you can imagine, I don't see that going anywhere. The only risk you get with life science is just the funding. It's a lot of venture capital funding as well as NIH funding. So that should that funding get pulled. Medical office is really interesting. I think it's going to be separated into, I'm very bullish on medical office that caters to higher acuity. And by that, I mean, you need shoulder surgery, you need hip surgery. Those things aren't going to go away. You can't get that done online or done via telehealth. Now, what's been very interesting is some of the lower acuity stuff that has moved to telehealth, and I think that'll continue. I think doctors also appreciate that of they can actually move through sort of the higher profit margin stuff to their office and keep the lower profit margin stuff, do that via telehealth. So, it sort of remains to be seen what happens there in terms of, the lower acuity medical office. I could certainly see a world where, you just go to the dentist once a year instead of twice a year, at least in the near term. So I would say don't really know, but sort of that's where our thoughts lie right now. So the only other sector, we should probably talk about is traditional office. That's gotten a lot of airtime in the post-COVID world because people are really concerned. Not even concerned is the right word. Sort of just thinking about, will the work from home trend continue? Will businesses need less office space, or actually will they need more? Because in a post-COVID world, more people will have to be spread out farther. And so that will actually create more demand for office, or is it just a net neutral? You have some people working from home plus needing more space. Is that just a net neutral? Office it's a pretty big question mark, at this time. So I don't pretend to have the answers, but certainly that is something we're trying to stay on top of.
Yeah, I certainly, with my kids and all of us packed into a Manhattan apartment, I'm certainly looking forward to get back to the office. And speaking of strategies, you talked a lot about the different sectors and where our views are. So, from an investment perspective as Nuveen Real Estate, has that changed any of our strategy, or do you think that COVID's just accelerated some of the trends that we were already seeing and acting upon? And what do you think this means for real estate investors?
Yeah, I mean, listen, I think it is, and I don't think it's a paradigm shift. I think it's an acceleration of what we were seeing, and I think if anything, it has given us more conviction around some of these alternative property types, and so using that as an opportunity, right? So if we think about kind of the trajectory of where is this going to go, if we think about what happened in 2008 to kind of 2010 when all the distressed sales started to happen, it's a matter of time. It takes a couple years. Now, who knows? Because this, recession is just so markedly different. But I do think it'll be a great opportunity. Should any of the distress start to show up, we're certainly, are wanting to absolutely take advantage of some of the opportunities out there, particularly in these alternative property types. I think it's the time to actually start to get your portfolio. My personal view is that these pandemics will continue to happen, and if it's not the pandemics, right, it's 9/11, it's global financial crisis. It's kind of something every 5 to 10 years, and a lot of these alternative sectors actually give you the resilience and the diversification that you need from a core real estate perspective. So if anything, Wendy, I think it's just accelerated, maybe even given some real ammo behind and conviction behind these alternative property types.
Sure. No, I tend to agree. I don't think this is fundamentally going to change the landscape here, but certainly investors will tend to look more defensively and think about diversification. And, we talked a lot about the sector types and the impacts that this has on those, but, even locations, right? Cities, for example, are going to be affected in different ways. And I know that Nuveen and you and your team have done a lot of work about, which cities might fare better than others. And it'd be great to hear a bit more about that and understand the data and just kind of where you guys are more cautious and more bullish going forward, right? There's a lot of questions about density and people are worried about that, but yet, millennials and Gen X don't seem to want to flee to the suburbs. So what's your view?
Yeah, absolutely. So I think if we can go to slide 26 and 27, just start with slide 26. So as Wendy mentioned, we've been doing a lot of work around cities and trying to get what's been so tough, right, is that you want to have a view, and you want to know how to position a portfolio in a real estate book, but you don't really have the data, right? So you just don't know. You don't have clarity. But what we could do, and what my team has done is said, well, what data can we pull on cities to try to get a view on which cities will recover fastest and which cities won't. So what we did is we said, well, let's get to track a bunch of data points. And so what did we pull? We pulled the next two slides are actually just a couple examples of the data points we pulled. But here we definitely pulled concentrate every city's exposure to leisure, hospitality, retail, trade, and tourism, because these are going to be hit the hardest. And so we figured cities with this kind of concentration and exposure would certainly be hit the hardest and would struggle to, will recover. All cities, will eventually recover, but are going to struggle, right? So that was one data point we looked at. Then we said, well, what about, I'm really getting concerned about small businesses. And I think there will be a really big fallout in small businesses because I don't think the fiscal stimulus will be quite enough. So then we said, well, we also ranked the concentration that every metro has to small businesses. That was another data point we used. Then we also looked at the exposure a city has to state and local employment, and then versus federal government employment. And so state and local is certainly more at risk than federal. We also looked at what cities have more of a concentration to technology and healthcare. Now, this was a little controversial because we got a lot of pushback on the healthcare part. Now, what we did is we said, because you've read the headlines, actually healthcare, at hospitals has been falling off, right? Because you've had all these elective surgeries pushed due to the coronavirus. So what we did is we separated out healthcare employment at hospitals versus ambulatory. So actually, because ambulatory is actually seeing a huge increase in employment because of COVID. Meanwhile, the actual hospital employment is on the decline. We then looked at unemployment claims because those are delivered weekly. Figured that would be a very real-time feed on just how these cities are going to fare based on that. We looked at the population over age 65. We looked at the fiscal health of every state. And then we also looked at the percent of revenue that each metro gets from elastic sources. That's really the percent of revenue the city gets from income tax and sales tax. That's going to matter quite a lot because that revenue is going to dry up. And so some cities that have a lot of exposure to elastic sources of revenue are going to struggle pretty mightily. So what did we really find from this? Really, pretty interesting. What we found was, as you can see here, actually, if you go to the next slide, places like New Orleans, Las Vegas, that have a lot of exposure to the leisure, the hospitality, the tourism, a lot of parts of Florida are gonna really struggle coming out of this. Meanwhile, you've got places that are just better positioned. So you've got DC, which actually has a lot of federal employment, which actually probably do okay, and not much tourism or relatively less. We had places, a lot of the Sun Belt actually looks pretty good from all those metrics. Actually, pretty fiscally healthy. As well as a much less of an exposure to the tourism, the retail, the hardest hit sectors. New York clearly came up as one. New York, New Orleans, San Francisco came up as pretty hard hit too, even with its concentration of technology. Seattle as well, because it was the first COVID at the center. So that's what we're finding. Chicago as well, just because it has a lot of fiscal health issues. So that's what we really found. Sun Belt cities are really going to probably recover. Now, every city is going to be hit by all means, but some Sun Belt cities, sort of generally speaking, are going to recover better than the non Sun Belt cities.
Very interesting. Well, looks like I'm moving from New York to Las Vegas. No. Yeah, it really depends. It'll be interesting to see how this plays out, certainly. After being in the city through 9/11 here in New York, and then the world financial crisis, and now this, I tend to think people take a short-term view immediately, and it's the world's falling apart. But in the end of the day, a lot of these cities recovered pretty pretty robustly after those crises. So it will be interesting to watch this play out in real time. No, thanks for sharing that. So, just to shift gears a little, because I know some of the folks here, we've talked a lot about, equity and some of the real estate sectors, but, what are you seeing in commercial mortgage investing right now, on the debt side? Do you think that's a potential opportunity?
Yeah, I mean, if we move to slide 25, um, absolutely. I think, what we're seeing kind of right now, just from deal flow, certainly, spreads have definitely widened. And so, any study I've ever done, very obviously and intuitively, when you hit the bottom of a cycle, you make the most attractive loans or equity investments. And it's very intuitive. But we are starting to see spreads certainly widen. Hard to say, anywhere 100 to 300 basis points pre-COVID. So definitely opportunities starting to make its way through the pipeline. And I'd say from a historical perspective, what we can sort of expect. Now, historically, loss rates have been really high, have been the highest for lodging and retail, and even industrial, if we look at it historically, with multifamily being the lowest. I would suspect this time around, retail will probably, retail and lodging will probably see the highest loss rates, and will probably far exceed industrial, office and multifamily this time around. I would say it's another great time from a mortgage perspective, and you're seeing a lot of really interesting, deals come through, even on kind of the alternative property types. That I think this is actually the time when more people, those kind of property types and sponsors will need the capital. It can be a really interesting time to start making commercial mortgage investments.
Wendy, I think you are on mute.
Sorry, technical. You can't have a VC with without one technical problem. No, I was saying that we've seen a lot of flows into the real estate debt space, a little more on the distress side. And now it seems like there's a lot of dry powder, waiting to take advantage of these opportunities. So again, it will be interesting to see how this all plays out. Well, I want to be cognizant of time. I hope the audience has some questions. I'm sure that, Melissa, you've brought up some points. So why don't we, give a chance for some external questions, if you don't mind, Hank.
Sure. Melissa, Wendy, thank you very much for that great fireside chat. I thought that was very interesting. We do have some questions, but again, for folks in the audience who want to ask additional questions, please go to the GoToWebinar portal and please submit your questions there. Melissa, I believe when you were talking about student housing, you mentioned population and reproduction, and that as a long-term trend, student housing, the need for student housing may be going down. Does immigration at all impact any of that? And if it does, in what direction?
Yeah, absolutely. I mean, definitely at some of the top tier universities in America, they do get, a significant part of their student body is foreign students. And so, to the extent that we really clamp down, the U.S. government clamps down on immigration or allowing foreign students in to study, that'll be another negative for the student housing sector. And so I think, even beyond that, what you have is some, kind of third tier universities are seeing declining enrollment. Many have shut down. Places you never heard of in smaller towns, but overall enrollment is on the decline, has been for 7 years, undergraduate full time, and that's even with the imports of foreign students.
And then I guess picking up on the last conversation that you and Wendy were having relative to cities, I guess particularly in the Northeast and in the Rust Belt area, there has been over the last 10 to 15 years, sort of a renaissance in city centers revitalizing. Do you see that trend, overall taking a negative hit because of COVID?
It's a good question that I get a lot of people saying, everyone will move to the suburbs. Listen, I think the suburban movement, from what we use StratoDem, which is an AI-based demographic tool. So the movement to the suburbs, population growth in the suburbs was well underway pre-COVID. But I don't think that has to mean the demise of urban areas, right? Because a lot of that will be, millennials moving out to have children. But you still have Gen Z, right, and younger millennials who I think still want the urban environment. I think what you actually get, is if you think about really expensive cities like San Francisco or New York, this will probably actually be a positive in that rents from a retail office apartment perspective, they got so high that it drove out a lot of the diversity, the pop-ups, the experimental concepts, the restaurants, it drove a lot of that out. And so, while those cities will experience, rent and value declines in the near term, what it does is in the 5 to 7 year term, you'll actually, because rents and values will fall, you'll get people to move back in, and you'll actually come out with, cities that are, more vibrant. I mean, I hope, this is my hope, that are more vibrant, and are more what, people always wanted from a city. And so, I always, it's not all negative, and I don't think it's the end of urban living or cities at all. But I do think it's certainly it's just be a regeneration.
And I know that you've covered this as part of your overall conversation with Wendy, but in terms of sort of the COVID impact on real estate, I guess it bears repeating. What do you think have been the most challenged by the COVID crisis?
Yeah, I mean, the sectors that have really suffered have been lodging, retail, and senior housing so far. And that's really from a pure, I mean, with lodging, there's no business travel, there's no leisure travel. You have RevPAR, which is, really just a measure of revenue, declining 80 to 90%, relative to pre-COVID values. So you've got that, and that's really not going to recover until, you get the U.S. economies reopen, until business travel and leisure travel picks up. And then retail, as Wendy and I spoke about, you just had a bunch of retailers that weren't in great financial shape, quite frankly, heading into COVID. COVID hit, and they're in much, much worse financial shape, if not on the verge of bankruptcy or filing bankruptcy, right? J. Crew, Neiman Marcus. I think more and more of that will come through, and it'll kind of clear out what were, I'm not going to say zombie companies, but certainly not financially healthy, retailers. And then senior housing has been one that also has been hit pretty hard, and that's mostly because of the coronavirus. The fatality rate is so much higher among the elderly, and so, if the coronavirus hits any single, senior housing facility, it's catastrophic, quite frankly. I mean, you have an entire resident population that is, facing death. And so, you've got that to deal with, and that's raising operating, costs and expenses for those operators. And certainly it's even, making, some seniors rethink, hey, maybe I don't go into a senior housing facility until I absolutely have to, until I just cannot take care of myself, because it could be a death sentence if another COVID happens.
Yeah. And Melissa, regarding your comment about leisure travel, does that apply to amusement type of real estate as well? For instance, like a Disney theme parks?
Yeah, absolutely. I mean, I don't cover that, really closely, but yeah, absolutely. Yeah, I mean, until you can kind of get the economy reopened, all of those have been shut down, just like the casinos have all been shut down in Vegas. And until those can reopen, and until people feel comfortable, quite frankly, in large crowds, those types of entertainment properties are gonna struggle.
Great. Those were all the questions we had. Wendy, Melissa, did you have any final words before we wrap up today?
Let me say one thing before Melissa wraps up. Just on the last question, because a lot of what we sound like we're hearing is doom and gloom. But I do think there are nuggets of opportunity here, right? And it's not all negative, and a lot of this was already accelerating. Quite frankly, for the last 5 years, real estate investors were probably waiting for this to happen, and there was bound to be a correction, so to speak, in some real estate valuation, and there's going to be a bifurcation, right? There's going to be some asset classes that hold up really well and some that don't, some locations, and newer portfolios with modern, tomorrow's world proof assets. I think our general view is have a bright future. And just one anecdotal piece of evidence. So Nuveen manages several mall funds, and basically every shopping mall is closed. But we do have a China mall fund, and one of the malls is in Wuhan. So we get a lot of data coming from that mall, and of course, it followed a very similar pattern. The mall shut down; it was totally closed, and as the mall opened up, we've seen a complete return to foot traffic there. In fact, increased spending, and an increased desire for people to be out and about after spending such a lengthy period of time at home. So we follow the Chinese malls that we own closely as a bit of a precursor, which I don't think decelerates the adoption of e-commerce, but it just puts more options out there. So like Melissa said, the strong retailers that were already well positioned and have a more experiential component are, at least from our evidence, seem to be doing very well. So just be smart about where you put the money, because right now it's it's a question of the winners and the losers, and it's not all doom and gloom. There's going to be interesting investment opportunities coming out of this.
Melissa, any closing words?
No, I do echo Wendy's comments fully. It isn't all doom and gloom. I do think there are going to be a lot of opportunities that come with this, whether it be at the property type level or the city level. And it's just a matter of us, staying on top of it and researching it.
Well, I want to close by thanking both of you, Wendy and Melissa, for that great presentation today, and thank you to Nuveen for joining us, and thank you for to the audience members. Please join us for our next webinar entitled "Protecting Your Investments from Corporate Misconduct in a Time of Emergency" on Thursday, May 14th. Thank you, everyone.
Thank you.